Good evening, everyone. Welcome to Admiral Markets. My name is Chris. Nenad is with us today. We're going to take a look at best indicator combinations in Forex together. So looking forward to this webinar. I think that indicators and tools are great material, great tools and great methods and help us with analyzing and making decisions, but there are definitely indicator combinations that are better, and there are definitely times that indicators make more sense and balances that we need to find when approaching trading. So that all we're going to discuss in this webinar tonight. Before we actually take a look at that though, please be aware of this disclaimer. The material here is intended for global audience and may not be suitable for everyone. To find out if it is suitable for you and other details and conditions, please visit admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. You can use the same path, by the way, to request a copy of the risk disclaimer, which basically explains that trading for exchange and other financial markets are considered high risk and may not be suitable for all traders and investors. Therefore, please seek the advice of an independent financial advisor for more information on that. This webinar is not advice, it is for educational and informational purposes only. And by continuing watching this webinar, you agree with this disclaimer. Good. Welcome once again to Admiral Markets. Before actually kicking off the webinar, be aware of the special deposit bonus that's available throughout March. Depending on how much you deposit, you'll get a corresponding percentage from Admiral Markets, which you can use as an extra buffer. And if you reach enough volume, you can also actually get that bonus. So take a look, admiralmarkets.co.uk/landings/deposit bonus. And maybe that will be something for you. I think it's definitely something interesting, so certainly worth the attention and the minute or two to take a look. All right. Good evening, Ovidu and Justina. It's good to see you. We're going to take a look at the best indicators and tools in Forex trading. Now, I'm not including personally myself in my part, not price action and momentum and candles and candlestick patterns, because I always think that they're useful. I don't necessarily know why they wouldn't be useful, so I think that this is kind of like almost like just a concepts that are valid for no matter what, no matter which situation. You can always add it, and you can always add it to the mix, and you can always use it. So I'm not going to really combine price action momentum, candlesticks, and candlestick patterns with any of the tools and indicators, because I think that's like the base. I think that's something that is always valid, will remain valid. So basically, any combination that I will show you, in my opinion, you can add these four to it, and you got an interesting combination. So that's the first thing. Nenad, by the way, we'll take a look at his view, of course, in the second part. First of all, I'm going to take a look what is the importance of tools and indicators. Well, first of all, it does give us some information about what's happening, what's going on, what is price doing, and it basically helps traders identify a step and a spot on the chart, and we know then what to do when that time arrives. So let's say we're waiting for the oscillator to reach a oversold or overbought zone, then we know what we're waiting for, and when it happens, perhaps we can then look for other candlestick patterns to make a decision on a trade, for instance. So it gives us a way of analyzing, a method of understanding the market and price. But there is a drawdown, and a drawback is the fact that when we use indicators, it's quite alluring, it's quite tempting to use many of them. And we quickly kind of cross the border and go into the territory where we use too many, way too many. And when we use way too many, then our charts just kind of disappear, price disappears, and we just have this chart full of kind of information that is contradictory to each other and is difficult to interpret, and we just don't understand what's going on. So information is good, but too much information creates an overload and actually makes things worse and kind of slows down and hinders our performance. So we also, in that case, really don't know how these probability indicators work, or we can't even see them. We'll be actually missing trade setups we don't even have a specific role for the indicator. It's not like we have maybe a specified idea what the indicator role would be, which is also not so useful. Obviously, when you're using an indicator, you want to have a clear idea when you want to use it, and how you want to use it, and in what way, and what you do with it. That's very important. Ultimately, we move into a situation where we get paralysis of analysis, and we're kind of scratching our head and wondering what's going on. Alrighty. So obviously a balance is vital. Before I start diving into the exact tools and indicators combinations that I like, I want to start out with explaining that the balance is vital. The number of tools, how to use them, and when to use them is important. By the way, a tool I consider to be something that the trader, him or herself, puts on the chart. An indicator is something that is automatically there. You just add it. Okay, you have to add it, but then you don't have to do anything with it. It just automatically updates when price prints. For instance, a moving average is an indicator because obviously the platform calculates what the 20 EMA should be with every bar. We don't have to do that. It's an indicator. I consider that indicators. Tools are something that I have to draw on the chart, like a Fibonacci. That's something that I have to manually change. So just that slight distinction there. So balance is very important for a few things. First of all, so that we are not using multiple indicators with the same goal, not the same purpose, so that we have indicators that provide us different kind of analysis at different phases of when we trade. We also have, of course, to remain in balance so we can make sense of what we're looking at so that there's a coherent trading plan and we actually understand the chart, what we're looking at. The goal, in my opinion, of an indicator or tool is only threefolded. It's either to identify trend and momentum, it's to gather information about support or resistance, or about patterns. I think that at the end of the day, these are the key things to dissect and understand the chart in front of you. How we exactly define the trend and momentum will vary from trader to trader. The same for support or resistance and patterns. You might be looking at Gartley patterns. I might be looking at standard chart patterns. You might be looking at Ichimoku support or resistance. I might be looking at tops and bottoms. But the point is that no matter what kind of choice you make on these three things, ultimately I think all of us can define and understand what's going on with using these three things. Because when you look at the chart, you see, for instance, price in an uptrend like this, right? And at this moment, there's an uptrend, momentum is up. Where's the next resistance? Resistance is apparently there's somewhere here, let's say. Just a theoretical example anyhow, right? And pattern, at the moment, there's a small like bull flag on the lower time frame. You already have a ton of information there. You know that you don't want to short it at this point. Let's say there's no divergence for the moment. And there's a bull flag. So you have information about the direction. You have information about the potential breakout and what the target could be. Oh, here I have an example. That's quite useful. ARCAD weekly chart. Here, for instance, have a downtrend at this point. We have a momentum that basically completed. We had an upside momentum with the big wick here. Let's see. We have resistance as well at the fib, of course, at the 61.8 fib. So you can tie together here information about that. Now, when we're using these indicators and tools, as I said, for defining the trend, support, resistance, and patterns, we can basically, in my opinion, use those tools and indicators for the following kind of steps. The first step is getting kind of a general idea about the market structure. So, is the chart interesting? Does it say something to us that might make it less interesting? We're kind of looking at trend and filters. What is the general picture of that chart? Then if the chart seems interesting on a let's say on a bigger scale, we can move into a more practical approach. That's step 2, and actually start hunting and looking for a decision spot and trigger that could be interesting to trade. So let's say we like the structure of the market at that point, right? And we see, for instance, that there's a downtrend, and we just like this, the correction it's making. It's kind of making a bear flag like that. So at what point do we want to trade it? We could basically analyze it and say, okay, at this spot, when it retraces to this spot, and we see price reaching that level, that's the decision spot, and then we see a candlestick pattern at that decision spot, that's the trigger. So that would be the way that we kind of assess where the trade happens. And the entry and exit, of course, is the exact details of the trade. Just because the trigger is there doesn't mean we have to enter right away. Actually, those could be separate. The candlestick pattern could be the signal to trade it, but the entry could be on a smaller time frame upon a retracement. Alrighty, so my first combination that I like, Fibonacci and trendlines. Fibonacci, of course, is a very famous, I think very popular tool, I think a very used tool, and justly so. It provides information about entry and exit, support and resistance, filters, bouncing and breaking spots, not so much about trend, but that's about it, I guess. You even have patterns connected to Fibonacci. So quite broad and wide tool, and I think very good tool. It's very good for discretionary trading. I know a strategy that's also very non-discretionary, but basically I like the Fibonacci and trend lines because of two things. The reason that the Fibonacci is basically very wide in its usage, but as I said, it lacks one thing, the trend. So with trend lines, we could basically identify the trend and use the fib in combination with that. We can use the fib as soon as price breaks through the trend line. For instance, like this, we have a trend line break like that. For instance, like this, you see it's a bad trend line, but let me draw a trend line like this that connects the 3 bottoms like that. So when price breaks through it, we can put a fib from here to here and wait for the pullback. Classical break, pullback, continuation, right? That will be a classical way of using the trend line as a breakout. But we can also use trend lines not only as a breakout and a potential trigger, but also to identify the trend and basically look for trades with the trend upon pullbacks, for instance. We can also even wait for bounces. Let's say we have this trend line here. On the lower time frame, when price is approaching this trend line, we will see actually price hit it, fall, and make a pullback. On the lower time frame, we could fib from here to here and find the pullback entry for more downside. We'll be trading the pullback, basically, like this, a pullback, but on a higher time frame, it's actually a bounce off the trend line. So this is quite an interesting combination that provides a lot of different potential. Here, for instance, we also see the initial bounce with the big weekly pin bar off of that trend line. And I, for instance, in real life, I took this trade. I put a fib on the weekly candle from high to low, waited for a pullback, took the 61.8. I don't know if you can see the arrow right there, and exited at the minus 61.8 there. All right, so I basically saw the bounce off the trend line. I saw the pin bar, the bearish pin bar, and I fibbed that candle and took the Fibonacci retracement and targets for that trade. So I think it not only is valuable for breaks, but also for bounces. Oh, what happened here? Sorry about that. Next one. Awesome Oscillator and Fractals. Awesome Oscillator is basically what you see at the bottom here, and the fractals are basically the triangles on top and on the bottom of price. What I like about this, it's pretty simple. It's very straightforward, and nothing has to be drawn. Nothing has to be actually decided in this way. I mean, no, these are definitely indicators. It's not a tool Actually, Fibonacci and trend lines are both tools, which I forgot to mention. So it's a very discretionary strategy because we both have to place the trend line and we have to place the Fibonacci. So we have to do both. This is kind of the opposite. Here we don't have to do that. We don't have to place anything on the chart. It's already on the chart, both of them. So I think probably a bit easier than the first one. The idea is that basically the oscillator gives the trend and the momentum, and the fractal is a support and resistance in a way, and also the pattern. Because if you look at the fractals, you can of course identify, for instance, bull flags and wedges with those fractals. So here the idea is that the oscillator takes care of the trend and momentum, and the fractal support and resistance. And when the oscillator is in a trend on a higher time frame and we zoom into a lower time frame, then breakouts below the fractals in a downtrend or above the fractals in uptrend could be taken as setups. All right, so that is basically, you can even add a fib to this. If you really want to take it a step further again and say if it's in a trend and we have two fractals, we can fib from fractal to fractal and then take the retracement, for instance, instead of the breakout below or above the fractal. But in any case, the idea here is to catch the momentum by taking the breaks here of fractals. All right, next one, divergence and trend lines. So divergence, we can use any tool, ARSI, a MACD, an oscillator as well, by the way. But I specifically want to focus on the concept of divergence when there is lack of power with the trend. So the trend is showing basically weakness in its direction, and weakness in the continuation of that trend of momentum. What happens basically is the price falls or rises very fast and then continues to fall, but not with the same power as it once did. And we see that on the oscillator when RSI, for instance, levels are lower with the break of the bottom or top than the original fall. In this case, what I mean is this. Here you see, one second, here we see the break of the bottom. Price is making a lower low, but the oscillator isn't. That's divergence. When we add trend lines to it, we can see the breaks, for instance, for bigger reversals and bigger retracements. Either a big break like this, I would consider this a bigger break, or even smaller breaks. In this case, we don't have a good example, but it could be on a lower time frame, even a falling wedge like this, and taking the break and reversal trade, in fact, to the opposite direction. So there are various degrees of reversal trades. This is probably the first one, this is the second one, and this is the third one. Depending on how much divergence, the more divergence, the better. Obviously, if we have like the euro yen back in, well, this is maybe a very old example in the meantime, but it's a classical one back in 2011 when the euro yen was way down at 88 or something like that. I don't know exactly, but very low. And we had divergence on the weekly, daily, 4-hour chart, hourly chart, every single time frame. Well, that was of course a big reversal trade. Well, it was not big. It was not big. It was massive. It went from 88 all the way nowadays where euro yen is at 140, 150. So that's an extreme example, but sometimes you get them. Fibonacci and moving averages, kind of the same like Fibonacci and trend lines, right? The trend line is kind of replaced by the moving average as a trend direction. I still wanted to mention it specifically because Fibonacci is, moving average is a different way of trend definition. It's easier. You just put it on the chart. You don't have to manually place it. I personally would recommend 21, 34 EMAs for that. That's what I use, which are also Fibonacci numbers, as you might have recognized. And basically, let me show you the chart. Basically looking for price to be in that trend and then looking to take fibs and retracements when price gets back to the moving average and the fib, basically. Right? So it's also a very useful combination, but very similar to the trend lines. Only the thing is that the moving average we don't have to add ourselves. Again, Fibonacci, it's number, I think the third time we're mentioning it, but this time with waves, Elliott wave analysis. Now, I guess everyone is a big fan of it, to place it lightly or modestly. Some definitely don't like it, but with Fibonacci, I think it's an interesting combination because of the fact that we obviously have a good idea where to place the fibs. Another interesting combination, which I didn't mention but I want to do now, is that waves plus the awesome oscillator is also a very interesting combination. And actually, with my wave analysis, use all three together. The waves and oscillators give a good idea about what the current wave count could be. It is a less discretionary tool than only using the wave rules. Wave rules and guidelines are great, but they leave a lot of space for interpretation. The oscillator kind of ties down some rules to that and makes it a bit more practical with estimating and assessing the probability of a wave count. If you want more information on that, because we don't have the time today, then I would recommend to take a look at Apple Markets YouTube page and type in wave or Elliott wave, and there should be popping up some webinars on that. If not, let me know and I'll try to fix that. Parabolic and moving averages. Here the parabolic is basically the support and resistance, and the moving average is the trend. This is one where we have both basically on the chart, so they're both indicators, nothing has to be done, and we can basically watch for breaks of the parabolic when the moving averages are aligned, or if you have one when price is below the moving average. Personally, I like to use two moving averages and one moving averages that has three of them as a kind of band of moving averages. So it depends how big fan you are of moving averages. I mean, but always I think one is never hurts. I think one always provides some information about the price relationship to its average. So even if you're not a big fan of moving average, I don't think one moving average hurts. I think it does always give some unique information that or confirmation that is useful. The Ichimoku indicator is a standalone because the funny thing about this indicator, it has it all in it. It's quite unique. I mean, it's in that regard quite universal and handy. Still, I don't use it because if I would use it, I would think I would only use this, because if I add more stuff to this, kind of gets crowded, kind of gets overfilled. So either I guess you use Ichimoku or you use other things. I have a feeling that in that regard, it's already quite crowded when looking at this chart. So if you would add stuff, it seems to me that it would be too much. If you like it, then it does solve kind of everything because it has momentum and trend, it has support and resistance in it as well. And well, patterns, you could even see patterns in it as well by looking at crossovers perhaps, or breakouts out of Kumu clouds, and looking for the Chiku span and its position. So actually I ran out. I thought I had some more, but that went faster than I thought. So those were just some combinations that I wanted to mention, but you can see kind of a red thread here. You can see kind of a main thread, maybe is the better word, common denominator, that I like combining indicators and tools that support each other with different areas of objectives, either through pattern, support, resistance, and trends. I think those give the most information. I think that for my own trading, I use moving averages, I use trend lines, I use basically Fibonacci, awesome oscillator, and on lower time frames the Camarilla, because mind you that of course one can vary the tools and indicators per time frame depending on the step. For instance, let me go back now and tie this together, and then Nenad is going to take over and share his view on tools and indicators, his favorite combinations for the next part. Now I'm lost where I am. Let's see, I think, yeah, here. this is what I wanted to show you. Basically, if we have, for instance, a moving average on the 4-hour chart, that could show the trend. And we could use a different moving average on a lower time frame to show momentum, for instance. We could use filters, we could use the oscillator. A decision spot could be a trend line, or moving out, or a fib, for instance. The trigger could be a candlestick pattern and a break of the fractal. An entry and exit could be also various combinations like that. Point is that each of these steps could be different time frames. The trend could be the 4-hour chart, but the filter could be when you look at the daily chart. The decision spot could occur on the 1-hour chart, but the trigger, well, also on the let's say, okay, decision spot and trigger on the 1 hour, and the entry on the 15-minute chart. We don't necessarily need the moving average, for instance, that defines the trend on the 4-hour chart. We don't need that particular moving average necessarily on the 15-minute chart when entry. We could indicate that by going to properties and saying, I only want the moving average on the 4-hour chart. So although I mentioned a lot of tools and indicators, perhaps, I don't know, depends how you look at it, you could kind of find that balance by using them for specific time frames. Some of us really use nothing at all and are pure price action traders. Some of us use a lot and are indicator, basically indicator-based traders. I consider myself in between. I don't want to totally rely only on indicators, and certainly want to avoid overcrowded charts, certainly want to avoid a chart where I have, I don't know, 10, 20, 30, 40 indicators and just can't see anything. That doesn't make sense to me. I do like indicators here and there, a few of them, just to give me some information besides candlestick patterns, perhaps chart patterns, and what else did I say? Price action momentum. I think those are great things, but I do like to combine it with a few indicators. So I think I'm just a kind of a balanced trader in that regard that finds the middle way with these tools and indicators. So let me now pass it over to Nenad. I think that I've mentioned everything that I can think of. I think that Nenad is certainly going to mention the Camarilla as well. That's one of my favorites too, but I use it for the lower time frames. Not sure if Nenad is there. Let's see. Could you please repeat the moving average you use with the fib? Yes, certainly. I like personally using 21 EMA, close, high, and low, and the 144 EMA close. 144 is basically the long-term trend, and the 21 is the short-term trend. The 34 EMA as a replacement for 21 is also not bad. I've long used the 34, but ultimately now using more the 21 because it's just a bit faster. It just hugs price a bit closer. So ultimately found that one a tad more valuable, but really we're talking about details now at this moment because the difference is quite small. If you really want an EMA that is very fast reacting to price and kind of gives momentum, then I would say a 8 EMA is good, a 5 EMA is good, 13, probably 8 is a good balance. 144 for the long term, yes, 144. I'll write it down. 144 EMA close, and then 21 or 34 EMA close, high, and low. And the reason why I use 3 is because I got a more footprint on the price. I think that moving averages is a good support resistance zone, but it's just an area. I don't think it's really one specific price point that is everything or nothing. I think it's more like a general region. That's why I like the band, because it gives kind of a support resistance zone, and I think it reflects in reality a bit more than just 1 point. All right, let's see. Nenad, are you there? Let's see if you can pass it over.
Yeah, thank you, Chris. Good presentation. I'm waiting for you to finish so I can continue. Indeed.
Great.
So, yeah, great presentation. Nice introduction. Now we will see basically what I have prepared for you today. And that is definitely, we will talk a little bit about Camarilla, of course, because it's my favorite indicator, and I already shared the indicator through Forex Factory website, I think. And now we need to first make a quick walk through indicators. Then we will talk about pin bars, of course, and some pivot points, then leading, lagging, dynamic indicators, Fibonacci, and general consensus. So, guys, if you want to be effective in trading, and if you want to basically tailor the system to suit your own needs, then you definitely need to consider using some indicators which will not cluster your screen. So that is the primary concern of traders, to have to keep the things as simple as they can be, because if you don't keep things simple, ultimately even the best of your system can fail. Okay, so it's very important for you to keep the simple as it can be, things simple. Of course, indicator is always useful, and having an indicator on the chart will tell you a lot of useful things. The first and primary motive of having an indicator is that it will tell you something. So it's something that it tells you something. Basically, traders really try to make all of those indicators a mirror of a price action. So if you see that indicator is behaving in a strange way, then maybe it's not a mirror of price action, but maybe it's mirroring some other tools, other things which are hidden behind the indicator itself. So the primary motive of having a good indicator is to be the mirror of price action. Now, of course, there are also other indicators which are pretty much very useful, and I'm talking specifically about indicators which can and will show you spread and pip value. For me, for example, in my example, it's that is the indicator which is very useful, and that is pip value and spread indicator, because when you trade 20 or 10 pairs, it doesn't matter, more than 4 or 5 pairs, you need to know the spread. You need to know the pip value, because the pip value is not the same for each pair. For example, euro-dollar has 10 pip value, I don't know, euro-yen has 8 point something, dollar-yen has 8.2 or such thing. So it helps you. Next month I will be also scheduling, I schedule already a webinar, so you will be sure to sign in when the promotion kicks in. It will be about how to set up your own trading room, and I will talk about how you can set up your own trading room, monitors, indicators, useful things to have as your office. Okay. Now let's move on to next thesis. It's basically the indicator is always a mathematical calculation which is based on price itself. So it doesn't matter if it only shows you the price as a leading or lagging indicator. It's always some mathematical calculation behind it. The indicators use statistics to measure current conditions, to define a trend, to confirm a trend and entry, and to place stop loss and target price. Now, this is the primary concern with indicators. Definitely, guys, pay attention what I say here. To define the trend, to confirm a trend and entry, and to place stop loss and target price. If you have more indicators to define a trend, more than one indicator to confirm a trend and entry, and more than one indicator to place stop loss and target price, you will be confused. You definitely would consider a less clustered chart, because you will not know what you should trade, what you should pay attention to. It's very hard to trade if you if you have a lot of clustered indicators. Okay. So one more thing to remember: primary use of and purpose of using indicators is to define a trend, to confirm a trend and entry, and to place stop loss and target price. Okay. More than single indicator for each of these things will get your chart clustered and you will be confused. Okay. I hate to see clustered chart, really. Now, classification of indicators: leading indicator, so-called oscillator. CCI can be good for an entry indicator, guys, and if you want to consider trading with indicator entries, you can consider CCI. It's good. RSI is also good indicator because it's a mirror of price action. It's a leading indicator. Also, stochastics is very useful entry indicator, and a lot of traders use stochastics for defining an entry. Now we also have a classification of lagging indicators. Those are momentum indicators. Guys, momentum needs to be captured. Okay. When you capture the momentum, you need to align the trend. When you align the trend, now probably most of you have seen my analysis of euro dollar today. I hope that you have made money because it dropped more than 100 pips, and it was a great indication I will show you that later, how I captured the momentum by using MACD and Camarilla. So the thing is, for me as a price action trader and a creator of Camarilla MACD strategy and method, momentum is everything in day trading. When you align momentum with a trend, you can have a retracement. If you have a retracement, that means that you will sell higher and buy lower. If you want to trade properly, not as a newbie traders, and I'm sure that most of you who have been attending mine and Chris webinars are definitely seasoned, okay, and you know how to basically place a good entry, and you know that if you want to go with the trend, you need to sell higher and buy lower. The question, RSI is both leading and lagging. In my opinion, net RSI is completely leading. I'm not governed by those, I don't know, internet forums and descriptions of indicators, because I have used RSI in the past. I really was a fond of RSI indicator, and I use it a lot. And RSI is a leading indicator because RSI is detecting the trend. RSI, you can plot trend lines on RSI, and if you watch how it behaves compared to price action itself, you will see that RSI is leading indicator. Now some people are telling that it's lagging. No, in my opinion, it's completely leading indicator. It mirrors the price action. You can plot trend lines. I have described it many times during these webinars, and it's definitely a mirror of price action. Okay, so it's not a lagging indicator. It's leading indicator. MACD is lagging indicator. There is a difference between MACD and RSI. So MACD, yes, it is definitely a lagging indicator, but it's considered a momentum indicator. And because it's a momentum indicator, that means that it's lagging, and it's great for capturing the trend indeed. RSI indicator, momentum, you have also momentum, which is basically, I find, for example, MACD a lot more useful than momentum indicator itself, because I'm really not sure that momentum indicator has so many uses in chart in intraday trading compared to MACD. MACD for me is a lot more useful than momentum indicator. And momentum indicator, momentum indicator is also an indicator which comes with the default MT4, but I personally don't use it. We have also ROC indicator, rate of change. Then we have on balance volume, OBV. For example, I did some studies on OBV back in days on Forex Factory thread, and yeah, OBV is very useful for spotting divergence. So if you want to test how OBV is spotting divergence, you can do that. It's actually good for spotting divergence trades. Yeah, OBV, on balance volume. Then we have also moving averages, which are definitely very useful because moving averages are dynamic support and resistance levels. I don't refer to moving averages as crossover indicators because those crossovers and trading crossovers can be very, very dangerous if you trade it during range periods, because when price is ranging you will see DNA spirals. Now guys, do you remember when I talked about DNA spirals? If you remember about DNA spirals, those are DNA spirals, EMA DNA spirals, just IPS. If you don't remember, I can remind you. It doesn't matter if you remember or not, I will definitely remind you again. DNA spiral on EMA or MA indicator looks like this, guys. It looks like this. Okay? Yeah, Loy is saying he remembers. So guys, if you see this price action on MA indicator, it's a spiral. You will lose, and you will lose a lot. Okay? That is a very, very dangerous thing to have on your charts, and those EMA or MA crossovers can work wonders in trending environment, but you know guys, which indicators do not work in trend environment, right? But it wreaks havoc on standard ranging intraday time frames. So you definitely should stay out of it. Those are dangerous to have on your charts. Those are not for you guys. You should definitely consider another method of having an entry, not crossover. In ranging market, it kills. Okay? Then we have simple SMA, exponential MA, smoothing MA, linear regress moving average or LMA, Bollinger Bands also are dynamic support resistance levels, okay? Static support resistance levels such as Camarilla or pivot points, which are definitely very, very useful. Now, definitely in my opinion, how I use price action, Fibonacci retracements are one of most important entry. Can we call Fibonacci an indicator? Yes, it is an indicator, but it is a discretionary indicator. So I definitely, you probably follow all the analysis me and Chris do for you, so you probably see that in each of my analysis, almost in each, but most of the time it's 99%, I include Fibonacci retracements. Fibonacci retracements are definitely one of my favorite tools for capturing the entries on supply-demand zones, so I call it POC. POC are basically modified supply-demand zones, and Fibonacci is very, very precise tool to use as an entry indicator. It captures the trend, it captures, it's easy to define a trend, it's easy to define retracement within the trend. So, how you use, and Justina is saying Fib is an amazing tool, my favorite. Yes, Fibonacci is indeed my favorite for spotting POC, of course, along with Camarilla, but Camarilla is static indicator used for spotting a confluence. How we draw Fibonacci? Always the same pattern, from left to right, because we don't go from right to left, it's wrong. We go from left to right, okay? In uptrend, we go from bottom to top. This is point A, this is point B. So from bottom to top, left to right, okay? In downtrend, we go again from past to present, from left to right, okay? And from top to bottom. So no matter what you have heard about Fibonacci retracement, I know that many seasoned traders even do it wrong. We teach you how to do it properly. You never plot your Fibonacci from this point to this point. It's always left to right. Remember that. That is a classic teaching of price action. That is how it's always done, and that is how majority of hedge fund bank traders do. And you want to follow a shark, you remember, you want to follow a big shark, big money, so you plot your Fibonacci from left to right, from bottom to top, from top to bottom in downtrend, okay? But always from the past to present. Because why from past to present? Because price repeats itself. If it was bought somewhere in the past from this point, it will be bought again in the future, in the present, guys. Price action repeats itself, okay? Pivot points, standard pivot points and pin bars of 4-hour and daily. You already know how classical pivot points indicator looks like. This is classic pivot point, R1, M3, pivot, M2, support. So this is a classic support resistance indicator, okay? Now I will share the screen with you to show you Camarilla MACD, and I'm sure that if you haven't got it yet, I have shared it. I just confirmed that you can see my euro-dollar chart and my pivot point, Camarilla pivot. Yes, Loy is saying yes, yes, everything is confirmed. Great. So guys, I have shared the indicator on my thread, Forex Factory Spiders Den. This indicator has been made specifically for my purposes by a good trader and friend from Croatia, Mick FX. He is the creator of this indicator, and I use again this opportunity to thank him again for modifying existing Camarilla indicator and sending me this. This is great indicator, and I really love how it plots these lines. It's very clear. It doesn't cluster the chart. We have also ATR on the top of it. Great tool, the best tool, really, the best of the best of all Camarilla indicators on the internet. Look at this. You can definitely choose to period, weekly periods, daily Camarilla, 4-hour Camarilla, history of Camarilla, but great indicator. Well done, Mick. This is really the brilliant of all indicators, because I'm really, you know, I'm very fond of loving, very fond of Camarilla pivot points, and I'm really loving it to its maximal potential. And you remember our trade from today. We had a great, really a great trade on euro-dollar, guys, and we had a good confluence here. And if you remember the analysis from today, the price came exactly to our entry zone, and then it was rejected for more than 100 pips. Are you, just tell me that you made money from this particular trade, and I will be very, very happy to hear, because this is, today it was the opportunity to go really, to have a really good short on euro-dollar. And what helped us in this, at least helped me in this analysis, and I hope that it helped you, is basically, look at the confluence here with Camarilla. H3 confluence, daily pivot point, previous breakout retest zone, and definitely Fibonacci, important Fibonacci zone here. So again, I know that many of you follow this analysis and all of this blindly. It's okay, I don't mind. But if you use your own system for trading, if you want to create, I don't know, your own system or method, pay attention to Camarilla. Maybe it doesn't help you as much as it helps me, because Camarilla MACD is a method which I basically, I created, the inception of Camarilla was last February, and I did a good job in creating method, because it lasted for 2 years. So it took me 2 years to create Camarilla MACD method, guys. And Camarilla definitely is one of my favorite, definitely my favorite indicator for plotting static levels of support and resistance. Yeah. Loy saying, did some few minutes after Draghi started speech. Well, great. Even if you made 20, 30 pips, it's still good. And it's still free money, right? Now, let's see. Okay. So the conclusion, if you don't use Camarilla indicator, try to plot it on your charts and try to see how it behaves in accordance to your own trading system. Now we will talk a little bit more about leading and lagging and dynamic indicators. So EMA, stochastics, and MACD can give you a good combination. EMA serve as dynamic support resistance, MACD as lagging, stochastic as leading indicator. Okay, MACD, okay, once more, MACD is a lagging indicator, guys. Okay, MACD captures the trend. EMAs, you can see how the price reacts to EMAs. EMAs serve as dynamic support resistance levels. Once EMAs are touched, there probably be a bounce or rejection depending on trend direction. And stochastic, which is a leading indicator, it can give us the entry. Okay? Fibonacci can be added always. Okay? You know about that. But pay attention to this chart. We have dynamic support resistance level indicator, which is a pair of EMAs. We have one entry indicator, which is stochastic. We have one trend capturing indicator, momentum indicator, which is MACD. So the chart is not clustered. It's clear to see, it's clear to read. Now, the conclusion is you always need to have one leading, one lagging, and one dynamic support resistance indicator. The biggest mistake a trader can make is using a system which has two leading, I don't know, 3 dynamic indicators. More than one is not needed. Why it's not needed? Because the most successful indicator of all of those indicators will tell you the story. Okay? What is the most successful average indicator? For example, if we use stochastic as entry indicator, and let's say that we use EMA cross as an entry indicator, stochastic will be much more useful and it will give you better signals than EMA cross. You can only be confused when stochastics tell you one thing and EMA tell you another thing. Or let's say that stochastic gave you an early entry, but you didn't enter because EMAs got you another entry 2 candles after. So it can confuse you. Because always the best and the most successful indicator of all these will give you the primary entry. So you need to experiment. One leading, one lagging, one dynamic support resistance indicator. Okay? Experiment with it. Because for entries we use either Fibonacci retracement or well-known entry indicators such as CCI, stochastic, or MACD, guys. We use leading indicator to confirm the trend. You know about it already. Okay? So we use leading indicator to confirm the trend. We use also lagging, but leading indicator to confirm an entry. Okay? So lagging indicator to confirm the trend, leading indicator to confirm an entry. Or immediate trend, which of course depend on settings. It's not always the same. It's about the system. So we use entry indicator to pinpoint an entry. This is important. We use entry indicator to pinpoint an entry. We use either dynamic or static support, resistance level, and for specific methods such as Camarilla, we need to use more sophisticated knowledge, but we don't talk about it now. We talk about systems now. So once more, I will give you the most important points for this good system, and afterward I will show you how a bad system looks like. So good system should have one leading indicator for capturing the entries. Let's say this is stochastic. One lagging indicator or momentum indicator for capturing the trend, which is MACD. And one dynamic support resistance level to see the bounce of an immediate trend. And this is dynamic support resistance EMA. So one leading, one lagging, one dynamic support resistance indicator. That is how a good system looks like. don't cluster the chart with too many indicators. Some strategies that were useful 3 or 10 years ago simply do not work anymore, guys. Things have changed. Levels have changed. A lot of things have happened recently. And simply the things which gave us good pips back in time, they do not work anymore. Align the text and fund this, okay? Technical and fundamental analysis. If you cannot align, basically if fundamentals tell you one thing, technicals tell you other thing, they stick to technical analysis. Because most of the time technical analysis, of course, we are talking about intraday trading, it will win over fundamentals. It's best to be aligned, but if we cannot align, stick to text. If you're not sure what to do, always consult the professional, guys. Always and always. And definitely, guys, experiment with methodology. Now this is how bad system looks like. Definitely this is not for us. This is not what we want to do, because this system, it has too many indicators, guys. Too many indicators. I don't like how it looks. I wouldn't like to trade never this system. It has a lot of indicators, and basically if you see a similar system, you wouldn't know what to do, because this is how clustered system looks like, and that is very, very dangerous when you see a cluster system such as this one, guys. Okay, so remember the primary rules for creating system or methodology. It should be as simple as it can be. Keep it simple. KISS system, KISS methodology. Keep it simple, stupid. Keep it simple, sir, or just keep it simple. So guys, I hope that you enjoyed the webinar. If you have any questions, do not hesitate to ask me. Of course, Chris mentioned the bonus campaign. It's still here with us, and if you consider making another deposit, do it now, because it's always great to have expendable margin in your trading. Why not have 1,000 or couple of thousand or couple of hundred more dollars or euros in your account? Use this opportunity. Goran is saying, thank you for today's analysis. I got 100 pips. Goran, you are great, really. 100 pips, yeah. You basically caught a complete move. So very, very well done. Well done. So Goran is saying, yeah. And guys, yes, experiment with it. Follow me and Chris. We are here to help you. And yeah, Steph is asking how you use MA in this setup. This setup, guys, yeah, I don't use this setup. This is clustered, too much clustered. MACD, 3 MACDs, stochastic. So basically, I'm showing you a bad system. This is a bad system. Yet this is a good system, but we will talk about it maybe some other time. This is scalping method, but maybe we'll talk about it some other time. It has its own rules. So, guys, thank you again for listening. We will be here with you soon. Do not forget to sign up for next set of webinars with me and Chris during next week. Live webinars, of course, weekly Forex recap, where we hopefully will have another good week. We had a good week behind us. This was very good week considering how market was moving, and all of our setups were really, really successful. So sign up for next set of webinars. We will talk more about specific currency pairs. Thank you for listening. Thank you for your patience. I don't see any further questions, so we can call it a day. Yeah. Thank you, guys. Thank you for your comments, and we will talk with you soon. Cheers and trade safe.